Mr. President, we are ready whenever you are.
Are we ready to start the meeting?
Yes, Mr. President.
Okay, perfect, thank you. So it's 8:30 a.m. and I'd like to call the May 12th, 2023 meeting of the SDCERS Board of Administration to order. Rosie, could you please, do we have a quorum?
Yes, Mr. President, we do have a quorum with Mr. Louis Nguyen to be expected to join us a little bit later.
Okay, that's fine, thank you. Okay, I'd like to remind everybody when voting on an action item, please use the board voting system to record your moving a motion, providing a second, and for recording your vote. So before we move on with the agenda, please let me take a moment to welcome Chris Brewster. Today is Chris's first business meeting serving as the SDCERS board member. So Chris, welcome. Okay. He was elected by the SDCERS retirees to serve, and SDCERS is fortunate for his service, so welcome, Chris. I'd also like to announce that Bobby Spoon, will be continuing her service as our Business and Governance Committee Chair. Thank you, Bobby. Mm-hmm. Cliff Shearson will continue his service as our Investment Committee Chair. Thank you. And Tom Battaglia is serving as our Disability Chair, and I believe had his first meeting yesterday. Yep. So again, thank you very much to the committee chairs for your leadership and willingly shouldering the additional responsibilities and time commitments. So thank you, folks. Moving on to Section 3, public comment. Rosie, do we have any public comment today?
Yes, we do have two public comments. One will be Mr. Joe Flynn, who will be joining us in just a second for his public comment. And then we also have Mr. James Cunningham, who's the attorney to John Fry, and he will be speaking today on behalf of John Fry during our public comment with the business operations action item number 2. So we'll hold that comment until number 2.
What do you want to do with the first one?
Yes, Mr. Joe Flynn.
Okay. Thank you, Joe.
How do I start it?
Good. Thank you, Joe.
President Kaufman, first I want to congratulate you on your reelection.
Thank you.
That's keeping the good things going. Members of the board, my name is Joe Flynn. I'm a seasoned retiree. I'm one of those chronologically endowed retirees who keeps SERS actuary Chiron busy recalculating because San Diego retirees are continuing to enjoy life longer. Today, I would like to express my deep appreciation to the board and to CEO Greg Rademacher and SERS staff. My appreciation to the board is rooted in my earlier term on the board and continued involvement. I was on the board during the major underfunding problem that we had, or as the Irish would call it, the Troubles. Then, as now, San Diego has been blessed with volunteers who will volunteer their time and talent to work through the problems and manage the system. It is that knowledge and experience that keeps everything on course. I do want to, on behalf of other retirees, thank you for your efforts in managing the pension fund. It is critical. And I also wanted to thank outgoing trustee Charlie Hogquist, who for many years did outstanding work on the board. And now I wanted to welcome to the board our own retiree representative, Chris Brewster. The retirees are fortunate to have Chris, a person of his talent and energy, and I am sure he will be a welcome addition to the board. Thank you for your time and I do much appreciate your continued involvement. Thank you.
Thank you very much. And we look forward to your continued longevity in impacting our financials. Okay, let's move on to Section 4, approval of consent items. These are service retirements, the addition to the drop entries and the drop retirements and the training program. So may I have a motion and a second for a consent agenda items A through D? Okay, I think we've got a first and a second, so if everybody could cast their vote, please.
And Mr. President, with all votes in, this motion passes 11-0.
Thank you very much, Rosie. Okay, let's move on to business operations, section 5. We have 2 business operation action items on the agenda today. So starting with our first action item, which is the confirmation of the board vice president. So Greg, can you please introduce this?
Yes, thank you. It's a pleasure to see the board members here today. The board, SDCERS board unanimously appointed Paul Kaufman as our president to a second term at their March 2023 meeting. And the SDCERS charters and policies provide for President Kaufman to appoint a vice president with a concurrent vote of the board. Concurrence vote of the board. The President Kaufman believes Lisa Marie Harris is a well-qualified to serve as SDCERS vice president due to her service as SDCERS vice president this past year, her professional experiences, leadership roles with trade associations, and a very strong leadership skill set, which includes using SDCERS Core's values of customer service, accountability, professionalism, fiduciary integrity, and transparency. The board's confirmation of Lisa Marie Harris as SDCERS vice president will require a motion followed by a second and at least 7 affirmative votes.
Thank you. Would anybody like to speak on the matter? Okay, can I have a motion and a second? Do we have that? You have it. We have that? Good, excellent. So a motion before the board, please record your vote.
And with all votes in, Mr. President, the motion passes 11-0.
Thank you very much. Lisa Marie, congratulations. Good. We will move to business operation item number 2, which is the staff's recommendation to deny the request to consider the board's decision to deny the industrial disability retirement application of Mr. John Fry. Rosie, do we have any public comment on this?
Yes, we have Mr. James Cunningham, who will be speaking on behalf of John Fry, and Mr. James Cunningham is John Fry's attorney.
Good. I see Mr. Fry is coming to the microphone. Thank you very much.
This is Mr. Cunningham.
Mr. Cunningham, excuse me.
Yeah.
Okay,
I used to-
welcome. It's been a while.
I used to appear here all the time. In fact, it was before the 3-minute rule, and I was the reason for the 3-minute rule.
Oh, really?
Yeah, yeah. But I'll try to keep this quick.
Please begin when you're ready.
Yeah, thank you. I'm Jim Cunningham, as I stated. I honorably represent Captain John Fry, who's been with the fire department for over 30 years. I'm also general counsel for Local 145, which is the union that represents all the firefighters here in San Diego. There's really, the one issue, the one ask, if you will, that I'm making of the board here is that Captain Fry be given the opportunity for a hearing. This staff is the best. And so I didn't mean to imply by our petition for reconsideration that the staff has done anything wrong here. This is one of those emperor has no clothes kind of case. No one can quite point to a reason that and we know that Captain Fry was on the drop program. We know that to be a fact. We know that he went to the very last day of his drop program. But we also know that last year before he left, year and a half, he was out on workers' compensation. The last year of employment, the last year on drop, he was getting 48.50 time. And the staff report says he was getting full pay, indeed, but it's pay because he was disabled from multiple surgeries. The last day he was on drop, and he was retired because he was on drop, he was disabled. And so we know that if he wasn't on drop and he retired, he could retire service pending industrial. And then when his disability was finally formalized with permanent stationary report, you would send him to a medical evaluation, and if it was proven that he was substantially incapacitated, he'd get it. And if he didn't, and there was a conflict, he'd go to a hearing. So the only thing that Captain Fry is asking for is the ability to go to a hearing and let a judge determine when the last day he worked for the city of San Diego for the as a firefighter, was he disabled? And we know that you can leave and retire and have your disability status established after you retire for up to 3 years. That is his only request now. You won't find one case. There's no case out there that interprets whether or not this board has the right to send somebody to a hearing, because it's almost a case of first impression. The only cases I found were cases where a judge determined whether the person was disabled on the last day of employment, absent the fact that he retired on that date anyway. So that is our request and our petition for reconsideration in this matter. Thank you.
Thank you, Mr. Cunningham. This concludes our public comment. Sandra, would you like to comment on this, or please present this action item?
While it is true that people can service retire while their disability application is pending, we're always going to look back at what was their medical condition at the time of retirement. And in this case, Mr. Fry was still actively treating, so he was not permanently incapacitated at the time that he exited after his extension of his drop. So on June 24th, 2021, when his drop contract ended, he could not have stayed on 4150 pay on June 25th. And it has nothing to do with his permanent incapacity. We don't even get to that question. The question is whether his retirement was rendered necessary by permanent incapacity, and we find that his retirement was rendered necessary by the expiration of his drop contract. So that's really the only question before the board. And the board has already voted to deny the application. There's nothing new in the materials that would support overturning that decision.
Thank you, Sandra. May I have a motion and a second from the board members on this? Moved by Cliff and seconded by Brett Bartarola. Please record your vote. Oh.
Excuse me, Mr. President, can we announce the motion for the record?
Oh, excuse me.
Is it?
It's on the screen.
I would be happy to do it
Right
for
here.
you, if you
Go
would
ahead.
like, Mr.
Yeah,
President.
please.
Motion to deny the request to reconsider the board's decision to deny the industrial disability retirement application of John Fry would be our motion that we're voting on right now.
Good, thank you very much,
My
Rosie.
pleasure.
Okay. Do we have all votes in?
Yes, Mr. President, we do have all votes in with 8 yeses and 3 abstains, and with that, the motion passes 8-3.
Thank you very much. So this finishes our business thank you very much, Mr. Cunningham.
Thank you.
This finishes our business operations agenda item. We'll move on to section 6, which is the Disability Committee. Disability Chair Tom Battaglia, would you please provide your committee report?
Thank you, Paul. The Disability Committee met yesterday. We had one action item, staff's recommendation to approve the industrial disability retirement application for George Dugan. The committee approved Mr. Dugan's application for industrial disability retirement, as his application was supported by evidence of being permanently disabled, his disability being attributed to his work duties, and his disability caused the need for leaving city employment. Are there any questions from the board at this time before we vote? All right, so I'll move to approve, and you can please record your vote.
And with all votes in, Mr. Chair, this motion passes 11-0.
Thank you.
Thank you very much, Tom. Anything else? Oh,
Staff provided an informational item on reviewing Division 7 disability retirements of the board rules. Johnny Tran provided an overview of the recommended changes to the board rules covering disability retirements. The committee supported the proposed changes, which will be voted on as part of the Business and Governance Committee agenda action items. Staff provided a disability status report, and it's available in the board package. The disability status report, Sandra Clausen provided an overview of the disability application review statistics, highlighting the caseload. It's in good shape, with the oldest case in the 18 to 24 month category, which has been forwarded to a hearing officer. If there's no other questions or discussion, it's back to you.
thank you. Tom, thanks and congratulations on successfully completing your first Disability Committee meeting as chair. We're going to move on to Section 7, Business and Governance. So, Bobby, can you please introduce this one?
Absolutely. Thank you. The Business and Governance Committee met yesterday, and before I review the action items and make a motion for the consent agenda approval, are there any action items the board members would like pulled for discussion in a separate vote? Hearing none, starting with consent agenda number 1. Staff's recommendation to approve the annual cost of living adjustment effective July 1st, 2023. And this was presented by Marcel Rossman. Marcel reported that the Consumer Price Index changed 6.5% and resulted in the plan paying the maximum COLA adjustment of 2%. The committee approved the annual cost of living adjustment unanimously. Keep in mind that the difference between the 6.5 and the 2 goes into that bank, that's COLA bank. Number 2, staff's recommendation to review and amend the board officers and secretary's charter, the chief compliance officer charter, the education policy, board rule 2.130, which is non-pensionable compensation for PEPRA members of the Portland Airport, and Division 7 disability requirements of the board rules. And all of that was presented by Johnny Tran. Action item number 2 was also presented by Johnny and Marcel. Marcel spoke about the changes in the education policy, and the committee supported the changes as we discussed at the recent board retreat, and recommended an additional change to clarify new board members should attend an educational session, omitting the word one, so it was changed to an educational session or conference on retirement system, fiduciary responsibilities, and investments. Johnny noted the Disability Committee supports the proposed disability rule change, which harmonizes the beginning date of an SDCERS disability retirement benefit with the ending date for the city-paid long-term disability benefits. And this will avoid an overlap of benefits which requires the member to pay back the long-term disability benefit payments to the city. Our committee approved the action unanimously. Are there any questions from the board before we vote?
Oh, Chris, I'm sorry.
Chris?
Bobby, thank you very much. There we go. Bobby, thank you very much. I just wanted to reiterate some remarks from yesterday, which, since the entire board is here now, that over the last couple of years, inflation has totaled something around 13%, 13.5% based on our evaluation of that. And retirees are limited, as noted, to 2% a year. So historically, inflation's been just a little bit over 2% over the long haul. But in the last 2 years, all of a sudden, we're talking really a significant leap. And there's a good possibility that won't be made up for retirees in the years to come if we return to 2% inflation. So it's just a note. There's nothing that this board can do about it. The City Council has discussed it just a little bit, but it's something to consider. That's a pretty significant loss of buying power for retirees. And I would note that Social Security is directly indexed for inflation, whereas we have a 2% cap. So just information for the board. Thank you.
Thank you. Thank you, Chris. And we appreciate that. I mean, we appreciate the difficulty with these high inflation years. Do I have a motion to approve? Oh, and I don't need a second then. That's great. Ready to vote? Rosie? Brett?
With all votes in, Madam Chair, this motion passes 11-0.
Thank you.
Bobby, thank you very much for your committee report.
I'm not done yet.
Oh, I'm sorry.
That's okay.
Keep going.
Staff provided an informational item on retiree health practices and policies. Sandra Clausen provided the history of the city's retiree health care program, outlined SDCERS and city responsibilities, and gave an update on the status of the city's RFP for a vendor to assume SDCERS provided retiree health care services. It was very informative, and we would encourage the city to move on the RFP. Staff provided division reports and operational reports, and they are available in our board agenda package, and that's all I have. Are there any questions or comments from the board?
I don't want to step on your toes again, but that was it.
It's okay, go ahead.
Thank you. Thank you very much for your committee report, Bobby. We're going to move on to Section 8, Investment Committee. Clifford, could you please introduce this?
Sure, happy to. The investment committee met yesterday afternoon. The entire committee was present for the entire discussion. There were no information items. There were no reports. There were 2 substantive action items. There are 6 motions that comprise the first action item and 3 motions that comprise the second. Corinna and Aon will take us through some of this, I think, very interesting but important material. And I would just highlight for my colleagues, just cutting to the chase, on every one of the 9 motions, the 6 in the first and the 3 in the second, votes were in every instance 5-0. Corinna?
Thank you very much, Cliff. I'm going to walk everyone through the executive summary for our asset allocation action item. The asset allocation is a key responsibility of the investment committee, also the board. As Cliff mentioned, there were a number of items within this action item, and I'm going to walk through them at a very high level, and then I'm going to turn it over to our representatives at Aon for more in-depth analysis. So the first thing I'll say is...
Excuse me, Corinna, we've got 3 items showing up as documents. Are you on the second one?
I am on the PowerPoint slide, yes.
Second one? Okay, thank you. Yeah.
So the first thing I'll say is that these changes in their totality work to reduce risk. We are not changing with any of these recommendations the overall risk dial of the total fund, which is set at 78% to return seeking and 22% to risk reducing. And that risk dial is determined through a formal process, our asset liability modeling study. So today we're talking about optimizing within those allocations, the 78% and the 22% to return seeking and risk reducing respectively. So the biggest change, I would say, is the funding of a new allocation called private debt. And we will be using equity as a source of funds to fund this new allocation. Private debt has grown to a $1.2 trillion asset class, and the majority of our California public plan peers either have an allocation of private debt or are currently considering one. In fact, of the $1.2 trillion that I quoted, 10% of that comes from pension funds. So timing is particularly attractive with this asset class with the rise in yields and also the ability to demand stronger covenants. As I mentioned, we're looking to reduce our equity allocation, and we're taking or requesting to take 2% from global equity and 1 percentage point from US equity. When we do this, we will actually achieve a rebalancing to a 60% US equity, 40% non-US equity allocation, and that is consistent with a global equity benchmark. So that would be in line by taking from the US equity the 1 percentage point and then 2 percentage point from global equity to fund this allocation. We are also looking at increasing our exposure to infrastructure. The fund already has a 3% allocation to infrastructure within the real assets portfolio, and so the recommendation would be to take that to 4%. So that's an incremental add as well. Infrastructure is particularly attractive. It works to lower volatility. It also acts as an inflation hedge, and it diversifies equity beta. Equity risk is our greatest contributor to overall portfolio risk. So when we are taking from equity, we are working to reduce portfolio risk. Another recommendation that we have before you is to re-specify what we call our opportunity fund. So currently we have a 0 to 10% range within the opportunity fund, and this recommendation would limit that to a 3% max. But it's important to note that the current investments within the opportunity fund would be recognized as long-standing dedications. So those are our allocation to managed futures, which currently is at about 5%. That would transition to a portfolio called diversifying strategies. So that would be a lift out. And then we have another 2% in what we call opportunistic credit, and that would transition to the private debt portfolio. So even though we are limiting the max from 10 to 3, what we are currently invested in, which is just under 7%, would become standalone allocations. So there are some cosmetic changes here. The remaining 3% would be funded from equity. Previously, it would have been funded from both equity and fixed income. So going forward, that would be more of a de-risking of the equity portfolio for investments that are truly more opportunistic in nature. And finally, we're asking to extend or lengthen the duration or interest rate sensitivity of our risk-reducing U.S. fixed income portfolio. As you all are aware, we've had a tremendous increase in rates since the last year. The Fed has hiked over 500 basis points. And this is not so much a timing discussion as it is having a broader universe for our managers to invest within. And so intermediate duration typically runs securities that have maturities between 0 and 10 years, while core fixed income runs the full span 0 to 30 years. So with that, I'm going to now conclude my comments and turn it over to Aon to walk through greater detail. So we have Katie Comstock and Ashley Woosty joining us.
Sure. Excuse me. Go ahead, Chris.
Karina, just a couple questions for you. First of all, could you define what private debt is and how our money might be used? And secondly, are we talking about, is this about $500 million we're talking about allocating there?
It would be roughly about $500 million, as we have just over a $10 billion portfolio. So 5% allocation would correspond to about that number. It wouldn't be instantaneous. These are private structures that would take some time to build. So even if we decide today that we want to fund a 5% allocation, it will take some time to build up to that allocation. And I think we're going to talk in depth about what private debt is within the Aon deck, but essentially it's the ability to invest in private securities, funds that GPs raise, and they provide lending. Typically, there's core or direct lending that typically is lower risk than, for example, opportunistic credit or even asset-backed lending. So there's different types of investments within private credit. And today we're going to focus just on the allocation piece of it, and we would revert with portfolio structure analysis at a later time.
Okay, but I'm just trying to understand so we're essentially lending money, right? And so
Yes,
what-
we invest in funds, and then GPs put that money to work. They lend to companies so that they can secure financing for their operations. And it's particularly attractive in the current environment because the yields that we would earn have increased tremendously. And also, it's important to note that lending conditions have tightened, so we're able to demand stronger covenants too within those funds. So it's definitely an area that's garnering a lot of attention right now, particularly in light of the regional banking crisis that has just augmented that difficulty for these companies to secure financing in the current environment.
Okay, so we would essentially be loaning money to existing corporations that need funds for one thing or another.
Yeah, it would look like, for example, if you had a GP, let's just
GP.
a general partner, like for example an Apollo or an Ares, they would essentially fundraise for an LP, and our funds would be invested alongside other investors' money, and then that money would be deployed in loans to these sort of middle market companies, and they could then finance their operations through those financings, and then we earn the rates that are on those loans. Like we heard at our retreat that the yields are very high at the present moment, upwards of 10-12%. So that's very accretive to us, and it also is a reduction of our equity risk, which is our main contributor to risk. So that's important to note. Even though we're moving from public to private, this move in particular diversifies our equity risk, which, if you look in the documents, constitutes about 79% of the total risk. That's why this is considered a diversifying move.
And so this would be, in your estimation, relatively lower risk than equities?
Yes, it would be in the total portfolio context, right? So when you're adding in a particular allocation, you look to see if that makes sense in a portfolio context. And without speaking too much, we've done some additional sensitivities around the amount that we're investing in private debt. And what we find is that as we increase those allocations, the risk to the portfolio actually goes down, but it's at a give up of liquidity. So equity is very liquid. These are private securities. So there is some point at which you say, okay, I don't think we want to invest more in illiquid securities, but we can see through the analysis that if we have recommended here a 5% allocation, but we also tested a 10% allocation, that 10% allocation reduces risk further. However, it also impacts our liquidity of the portfolio, and that's why it was important for Aon to do a thorough liquidity analysis. And in doing that, they're looking at different type of market scenarios. They're looking at everything being really rosy, and they're looking at other scenarios that don't look very rosy at all. And so that's what they call dark skies, and then the rosy scenario, blue skies. So I think that's important to note, that as we're diversifying the portfolio into more illiquid structures, that we make sure we still have ample liquidity on hand in case there is a market correction, we need to pay benefits, and we just want to ensure that regardless of the scenarios that we encounter, that this diversification does not adversely impact our liquidity.
Thank you, and I'm cheering for Rosie.
We all are.
Thanks.
Sure. Go ahead.
Great, thank you. Good morning, everyone. It's a pleasure to be here. So I'm going to quickly, before we dive into the recommendations, just take a quick step back and add some context around the asset allocation review. We did briefly cover this at the board retreat. Not everyone was there, and we did have our time cut a little bit short, but I think it's important to have this background when we're thinking about asset allocation, because it is going to be the driver of the success of this portfolio. So in the overall investment strategy setting context, we always start with the asset liability study, and this is where we look at your liability profile and test different asset allocations to understand the impact on volatility of returns, contributions, funded status. And the outcome of this analysis, where we work with your actuary, and we do a liquidity analysis as well, is to see what your level of risk is. And that was confirmed at the last study, which was completed in 2021, with a 78% allocation to return-seeking assets and a 22% allocation to risk-reducing assets. And this has been the case for quite some time, and that's not unexpected. You all are a public fund with long-term long-term liabilities, and a little bit of underfunded status. So we need a growth-oriented portfolio. So we do that every 3 to 5 years. What we're talking about today is the asset allocation study, and that is the second column there on the right. And we do this on an annual basis. And what we're focused on here is how can we best construct that 78% return-seeking portfolio? What are the right asset classes at what weights? How are they working together? And then how do we construct that 22% risk-reducing allocation? What should those assets look like? And we're really trying to maximize your risk-adjusted returns in that context. We understand what we think the right risk level is from the asset liability study, and so we're trying to create the most efficient portfolio in that context. So that's what we're talking about today. Now, we had yesterday a lengthy discussion with the investment committee. It was a really great dialogue with the investment committee members, a lot of good questions, talking through these recommendations. And I'm going to jump ahead to talk through them. Karina had went through them in detail, but here on page 16 are the list of recommendations that are in this initial action item. And a few comments here just at the outset is that 6 does seem like a lot when we've been doing this on an annual basis. Usually it's been 1 or 2 over the past few years, but a number of these are more cosmetic in nature. We are not recommending any wholesale changes. There are some modest adjustments, and we'll talk about that we think will improve the expected risk-adjusted returns marginally, and that's what we're looking to do. We're assessing the market environment, we're assessing the outlook, we're assessing where you all are today and seeing how can we make some modest improvements. So though it seems like a lot, these are not wholesale changes to your asset allocation. The other thing that I want to mention is that when we package these all together, the overall outcome of this, as Karina had mentioned, is that we are improving the risk-adjusted returns. And the way that we're doing that is by reducing risk. So we're not giving up our expected return. We're maintaining a strong outlook on expected return, but we're adding diversification. We're adding resiliency into the portfolio by reducing that risk. And so that is kind of the theme of what all of these changes are. And at the next page, I'm going to land on page 17 as we talk through these changes. I think it may be a little bit easier to follow along to see the numbers as we move from your current policy, which is there on the left, to the recommended policy, which is on the right. So the first thing is the reduction in public equity. As Karina mentioned, this is your greatest risk factor. This is one of the primary asset classes that most public plans and growth-oriented portfolios are allocated to. This is going to maintain the bulk of your asset class, but we're just modestly reducing it by 3 percentage points. Again, adding diversification and reallocating to other return-seeking asset classes that are expected to grow nicely, but add diversification and reduce that public equity, the risk. And when I say risk here, we're talking about uncertainty of returns, volatility of your returns. If you go down, and on the right-hand side, the orange bold, as you all probably can tell are the changes from current to recommended. So as Karina mentioned, we are recommending a modest increase to infrastructure. The plan is to focus this additional 1% to more core-oriented infrastructure assets. Your infrastructure portfolio has performed very well for you all, particularly in this high inflationary environment. It has served to not only generate very strong returns, but to act as an inflation hedge to diversify the return. And it also provides exposure to a different economic type cycle. Stability of returns, income-oriented return profile. So a modest increase there, again, the idea being maintain return but reduce risk. The next line down is private debt. And this is where we're pretty excited about this asset class. We've been talking about it a lot with institutional portfolios, institutional clients as well. So here, you all currently have exposure to some private debt that is currently held under the Opportunity Fund. And we're kind of thinking about this as kind of a graduation of this asset class. So some of the characteristics, Karina explained what private debt was. Some of the reasons why we like it is because it is primarily senior secured. So you're holding these loans and you are the first person in that capital stack. So if there were to be a default or an event, you're getting your money paid back. So it's low risk. I might take a step back. There are a diversified set of types of debt, of private debt that you can invest in. There are core or kind of pure direct lending that are going to be less risky, and then there's more opportunistic or distressed that'll be a little bit more, there's a little bit more risk involved, but you're expecting a higher return. And so the makeup of this allocation will be the next step, kind of the implementation decisions. The expectation, though, is that the bulk of this will be that more pure play, lower risk profile private debt, making loans to corporations that need it. Some of the other characteristics of private debt that we like is that it's often tied to a variable interest rate. So as interest rates rise, you're able to benefit from those higher rates. The other reason we like private debt is, as the name implies, it's privately negotiated. So you're able to work with these companies and negotiate better terms, better yields, sometimes you can put floors on the interest rate if rates were to decrease for some reason, and other financial metrics that protect you as a lender. So there are a lot of favorable characteristics of private debt, particularly in an environment where we might be going into a recessionary environment. The return pattern of this asset class has been very favorable. The income component that's contractually negotiated has been very steady. Similar to core real estate, that income component is steady through different market environments. So that provides, again, diversified set of return and also downside protection. So it's an attractive asset class, we think, that will benefit the overall plan in the long term, reducing risk while maintaining a strong expected return. So to clarify, you have 2% right now under the Opportunity Fund. We'll be taking that out of the Opportunity Fund, adding it to its new asset class, and then we're recommending adding 3% to get to that long-term 5% target. The next allocation down, we are adding a separate line item called diversifying assets. This is another kind of graduation out of the Opportunity Fund. So this diversifying, that 4% diversifying assets represents your current exposure to managed futures. This was an allocation that the board approved in 2019 and has also done very well. It was up, I think, about 22% in calendar year 2022 when both bonds and equities were down 10%. The role of managed futures when it was approved was intended to provide returns that were uncorrelated to public fixed income and public equity, and offer also downside protection in downward trending markets, and it did just that. The role of this of managed futures was never to be short-term in nature. We weren't thinking that this was more tactical. It was always intended to be there for the long term, and you need to be patient with this type of asset class for it to work, for it to serve its purpose. Because there will be times when it does underperform, and for you to get the benefits of this allocation, you have to maintain that long-term allocation. So this isn't changing your current construct. It is graduating it, I'll use that term again, out of the Opportunity Fund and recognizing its long-term strategic role. The reason why we're not labeling it managed futures and instead labeling it diversifying is to offer you all flexibility down the road. There may be other asset types that could fit in this bucket. There are no plans today to change that. We think the managed futures allocation you have is appropriate and works. But down the road, there may be other types of investments that have these diversifying characteristics that we like that may make sense. So this will allow you the flexibility to add that if that time comes. And then one line down is fixed income. Here, there's, you can see we didn't write this on here, but again, the recommendation is to extend the duration of your policy benchmark. So right now, the opportunity set is intermediate duration fixed income, and these are US bonds that have a maturity from 0 to 10 years. That decision was made in 2014. It has been beneficial as rates have risen. The recommendation is to extend that out so that your bond managers can invest in bonds that have maturities from 0 to 30 years. This is giving them a bigger opportunity set to invest in and, again, enhance the risk return profile of the portfolio. And then the last recommendation isn't highlighted in orange, though it should be, and that's, again, to reduce the opportunity fund allowable range from 0 to 3%. And that's just recognizing that we're kind of graduating some of what was there today, the debt and the managed futures, into their own separate asset classes. So when we package that all together, at the bottom, there are a few statistics I'd like to point to. When we use our capital market assumptions, which are long-term assumptions for risk and return, we're looking at a total fund expected return, and this is long-term over the next 30 years, of an annualized return of about 7.5% for your current portfolio, at a risk level, which risk volatility of returns or standard deviation of about 12%. The change, based, if we look at the recommended portfolio, is a modest increase in expected return to about 7.7%, but a notable decrease in volatility to about 11.2%. And what that's doing, again, is enhancing your risk-adjusted return, meaning we would expect you to earn more per level of risk. And that's due to diversifying away from public equities and adding in asset classes that have diversifying characteristics, but also a strong return profile. The other important element of asset allocation is liquidity. Being a pension plan, you need to be able to meet these obligations when they are due. And so having your investments in alternatives that are not publicly traded and that are liquid, including private equity, infrastructure, real estate, as well as private debt, will be on that liquidity spectrum. We want to make sure that in stress scenarios, you have the liquidity that you need to pay your benefits. So the way that we approach that is through a liquidity analysis or a stress test. And so we bucket each of your asset classes based on the expected liquidity that they would be able to provide. And then we run them through different scenarios. And if I jump to that analysis really quickly, here we are, is the base case. This is kind of our median expectation. Things are, you're earning that 7.5%. Things are looking good. A recessionary scenario where we're seeing risk assets fall in the first few years and then a modest tick up. And then our dark skies, which is really the most pessimistic, scenario where we're seeing equities fall 50% over the first 2 years and really no recovery after that. So what these charts are showing is how your overall asset base from a dollar perspective would change. Those are the top charts across these scenarios. And if we focus on the dark skies, because that's where it'll hurt, that's where you really need to make sure that you can have the liquidity that you need. You can see that the asset level will fall from where you are today at about $10 billion, and then it will tick up and get close to that over the next 10 years in this economic, this scenario that we're running. The bottom charts show how the makeup of your asset allocation would change. So the illiquid asset classes are highlighted in those blue colors, blue through teal. And you can see as your total asset value falls, the proportion that your illiquids make up of your assets rise because you can't rebalance those. You can't typically get your money out, but your public markets are falling rapidly. And so what we're looking at is how much of your total portfolio will be comprised of illiquid assets because you wouldn't be able to access that to pay your benefits. And you can see it rises to peaks at about 60% of your overall assets and then kind of falls back down. The reason you're seeing it tick up and fall back down is partly because of the scenario, the economic scenarios we're running, but also because realistically, you would probably pull back on commitments you're making to illiquids if we are in a dire situation like this. But at the end of the day, the takeaway is that your portfolio will remain in good shape. You would still have enough liquidity to pay your benefits. Your asset allocation would be out of whack. There would need to be rebalancing, updated pacing that would need to be done, but we don't have concerns that you wouldn't be able to pay your benefit payments. Two other comments on this is that we do run this very conservatively, so we are assuming that some of your assets are more illiquid than they actually are, than we know them to be today. So we want to make take a conservative approach to this. And this also factors in your contribution policy. And that is a very important factor in this because it is assuming that your contribution policy functions as it has been and is responding to the year-over-year changes in your funded status and required contributions. So that is another important component to this liquidity analysis. So to wrap things up, and then I'm happy to take any questions. We're excited about these changes. It does look like a lot, but at the end of the day, what we're trying to do is improve the efficiency of the portfolio and improve the expected risk-adjusted returns. And so some modest changes from an allocation perspective and some reclassifications of existing asset classes. And let me pause there to.
I have a question. So I'm curious about the diversifying new asset class. Is that a known nomenclature in the industry that people know what that means? Just so that because I'm also thinking we probably need to put in our investment policy a clear definition. And so right now it's just managing futures, but you said it could be other investments. So I think it would be nice to just know that universe.
Yes, absolutely. And that's exactly the next step that we'll take. So there are some plans that have diversifying categories. There are plans that will call it something different. Some just use a broad term like alternatives. So there are a number of different names, and that's why it will be very important that the next step that we will take will be to take your investment policy statement and describe, just like we do currently, each asset class description. We'll do this for private debt as well. What does this mean? What are the risk return characteristics we expect out of this? What are the types of investments that can be allowed? How will we benchmark it? That will all be defined. And if you look at another plan that has a diversifying asset class, it likely won't look exactly the same. So that's why, to your point, it will be very important to lay that out. Thank you.
Go ahead, Chris.
Thank you. So Marcel and I had this really good experience of going to an event at Wharton a couple of weeks ago. And one of the really interesting presentations that was made there by one of the professors was a typical asset allocation of stocks and bonds, annualized rates of return in percent over rolling 5 and 10 year periods from 1900 to 2022. And on the 10-year, as an example, with a 75-25 equities to bonds, the return was 8.9% over that period of time, or over those periods, whatever I said, 1900 to 2022. I'm wondering how it is that ours anticipation is 7.6% in that context, because that seems like a pretty conservative and typical way to approach something like this.
Yes. So, I don't have those particular numbers. We do look at something very similar for your plan, right? We look at your risk profile, and so you all have 78% to return seeking. And so on page 12, we show just a 1-year, 10-year period, so this will change. But we show if you had all of that return seeking to public equity, and then 22% to bonds, so it's 78-22 mix, and then compare that to the policy that we have that diversifies that 78 with private equity, with real estate, with infrastructure, what that would look like. Now, the returns will vary. We do think that alternatives can generate higher returns than public equities. Recently, public equities have outperformed our expectations. That is true. It's hard to argue. You can't argue against that. You all have benefited from that, having that equity be the largest factor. But what diversifying that public equity allocation does is it reduces the risk. It reduces the volatility of those returns. So for instance, in 2022, public equities were down 18 or so percent. Your portfolio was down, I think, half of that because you diversified into other asset classes. And so that is kind of the balance of adding those diversifying assets. You can enhance return, we think, over long-term time periods, but you're smoothing the pattern of returns so that you're not getting returns year over year that are drastically different, because public equities are among the highest risk asset classes in terms of volatility. And so that impacts, not only your return profile, but also, the expectations on funded status and contributions as well. And so trying to smooth that pattern of returns without giving up return expectation is what we're trying to achieve.
Okay, so what I'm understanding you to say is that although we are investing for the long haul, and although those stats that I gave you were for the long haul, we're intentionally, so to speak, taking a hit to reduce volatility.
potentially taking a hit, though we do think that some of these asset classes can earn what public equities will over the long term. Private equity is there to enhance return. We think that over the long term, private equity will outperform public equities based on a illiquidity premium and skill that the managers can seek out of those privately held companies.
Yeah, but a pure play in the S&P 500 has returned over 9% over just about every time period for a long time.
Yeah. It has. Looking in the rearview mirror, that would have been a great play if you could handle that volatility. Looking forward, that's not our expectation, and so we want to set our asset allocation on our forward-looking expectations. And from our capital market assumptions that our team puts together, as well as other industry assumptions, we're not expecting that high of a return from public equities. And as well as we are expecting some volatility that we think diversification will help.
If I could interject just to draw your attention to the chart on the left-hand side here. So this is not exactly the 75-25% mix, and it's not over that length of time period, but it is looking back 10 years. And here you can see that the SDCERS policy, which includes alternatives and other types of asset classes, is upwards and to the left of the 78 public equity, 22% bond index. So it indicates that you're able to achieve slightly higher return for less risk. So it's essentially sitting on a different efficient frontier, if you will. It's just a more efficient portfolio. For any given level of risk, it's upwards and to the left.
Well, that wraps up our comments. I don't know if Cliff, you have anything else to add, but happy to take any other questions on the recommendations.
Cliff, go ahead.
Are we ready to go to a vote? I can move the 6.
Sure, let's do that.
Get to a page where we can see them. Already moved.
Oh, hang on.
So we are going to do, I think technically we need to do what, 6 votes?
No, just
All one.
Yeah.
Thank you. All right, so well, it's happening. And so we're waiting. You have a question? Go ahead, Chris, because everyone else has voted.
And Mr. Chair, would you like me to repeat the actual motion that was just voted on?
I think for the record, I think everyone knows what they are, but still, thank you. Yes.
Okay. The motion that you just voted on was motion to approve the staff and consultant recommendation to change the asset allocation to first reduce the U.S. equity allocation from 19% to 18% and the global equity allocation from 8% to 6%. Secondly, to reduce the opportunity fund range maximum from 10% to 3%. Thirdly, create a 5% private debt allocation. Fourthly, create a 4% diversity strategies allocation. Fifthly, increase the infrastructure allocation from 3% to 4%. And lastly, change the U.S. fixed income benchmark to Bloomberg Aggregate Bond Index. And with all votes in, this motion passes 10 with 1 no.
Thank you. We have our second action item, and Corinna, you'll take us through
Can I
these.
just ask a quick question?
Sure.
Louis isn't here. Should that be an abstain, or is it just no vote?
Just no vote.
Okay, thank you. I'm sorry.
The second action item relates to some recommendations about portfolio structure.
Yes, thank you, Cliff. So as we've mentioned earlier, this is the portfolio structure action item, and it includes 3 embedded recommendations. Before I get started, I would just like to do a bit of table setting. The board has already discussed global equity portfolio structure earlier in the year, as well as the portfolio structure for the return-seeking fixed income managers. So today we're going to be talking about the U.S. equity portfolio, the non-U.S. equity portfolio, and also the U.S. fixed income portfolio. So let's start with the U.S. portfolio first. For the U.S. portfolio, we have 2 indices currently. We have an allocation to the S&P 500, and we also have an allocation to the Dow Jones Total Stock Market Index. What we are recommending is to combine those or consolidate those 2 passive indices into one Russell 1000 index. And doing so will save us fees, estimated at about $100,000 per year, and also administrative expenses. The reason for this is that the Dow Jones Total Stock Market is in a separately managed account that also spins off proxies, and we pay for each proxy we vote, and there are thousands of them. So it helps us on both reducing investment management fees as well as administrative fees. And we still have full coverage of the U.S. equity market. It's cutting off just the very smallest cap companies compared to the current, the Russell 1000 versus the Dow Jones Total Stock Market Index. So it's beneficial from a cost savings perspective, and it's also a better fit with our current active manager, which manages to a Russell 2500 index. So keeping it all within that Russell family of index makes sense. And so that would be this first item on the U.S. equity. The second area we wanted to talk about is the non-U.S. Equity portfolio. And here, as a bit of table setting, I wanted to let the committee know, that our board know, that we are actually at the low end of the approved range of 175 basis points target for active risk within public portfolio as determined in our IPS, our investment policy statement. We're at the low range of that. And we have now, with the last item that we just approved, we have also reduced our allocation to global equity, which was the largest contributor to active risk. So with that said, we do have a bit of active budget, and we think it makes sense to go active where we believe active pays, and that would be in fixed income, as well as emerging markets and international small cap. These tend to be less efficient areas of the market. I'm going to hand it over now to Aon to walk through the analysis in a little bit more depth. But at a high level, this were my opening comments. Are there any questions at this time?
Chris, go ahead.
Thanks, Karina. On the domestic equities where it's moving over into, the Russell
1000.
Yeah, Russell 1000.
Yeah.
Just a couple of questions on that. I think it's great to do what you're talking about, moving into that index fund and the savings that you're talking about. What is the rationale to not do the same thing with that actively managed fund? Essentially, what we're doing is we're hitting large cap, mid cap, and small cap in varying ways, right?
Right.
So I guess my question is, why not use index funds that hit each one of
100%.
those, and also the management fees on the index fund you're aiming at? Did we go after a particular fund based on the lowest possible management fee? In other words, why BlackRock?
Well, let me back up just a moment. There were a couple of
Sorry about
questions
that.
there.
Yep.
So first of all, in passive, yes, it's a kind of a race to the bottom in terms of fees. In active management, it's not necessarily the lowest fee manager that you want to hire. oftentimes fees correlate with alpha. So better performing managers can charge higher fees, and on a net of fee basis, you may be better off. It's important to note that when we look at our US portfolio, about 94% of that is passively managed. So the bulk of our equity exposure in the US portfolio is passive. We do have about a 6%, 5 to 6, depending on the day, allocation to William Blair, and they run a SMID cap strategy for us, so it's a core strategy. And essentially in US small cap, as well as international small cap, you do find that this is less efficient areas of the market where active managers have a greater ability to add value versus a benchmark. And you can see this in multiple rolling periods of time where you can compare sort of how the median manager has done within that space compared to the benchmark after accounting for fees. This is not true in US large cap space. US large cap tends to be very efficient, and it's hard for active managers to consistently add value through their portfolio selection simply because the market is so deep, so well followed, and very efficient. To lay this out or give a little bit more context, it's hard for a investment manager, I think, my opinion, to discern sort of an information advantage by meeting with a CFO of, let's say, a very, very large company like a Walmart. But if an analyst can cover a small cap name that maybe very few other analysts on Wall Street are covering, he or she may be able to discern an information advantage. And so these tend to be less efficient areas of the market. It's true in US and it's true in international, both the same. And I guess while I'm chatting along, I think too we're entering an environment where we expect to see greater dispersion of returns. We've been sort of in a low volatility, beta-driven market for some time. We're coming out of that. I think we are out of that. And so at this point, I do think it makes sense to increase this budget that we have, or not the budget, we still have the target of 175 basis points, but we were at the very low end of that range. And so again, with the previous recommendation, we took away from global equity 2 percentage points, so that reduced our dollars that are actively managed in the public equity space because our global was 100% active. So US 95% passive, global 100% active, and then there was a mix of about 40% within the non-dollar piece. So there are certain areas here where there is a better ability for managers to add value after accounting for fees due to the inefficiency of the market, number one. Number two, this I think is an environment where you're starting to see dispersion of returns across managers. And I mean, let's just dive into this a little second more. We talked about the regional banking crisis. William Blair was actually not exposed to those names that were in the headlines. Moreover, it was actually underweight. So here you can see where an active manager has successfully tilted the portfolio away from those names in the press. Had you been passive, you would have been fully exposed.
Okay, and then, sorry, so that my other question, and thank you for that, was just when you decided on who was gonna, where we were gonna put, what index fund we were gonna put this in, because there's tons of them for that, I'm sure, for that index. How did you come upon BlackRock versus Vanguard or you know, whatever? Is it based on favorable fees, or what's the basis?
Yeah, actually, we have a relationship with BlackRock. BlackRock has also, when you have a number of mandates with an index provider, they typically provide relationship pricing. So you'll notice that BlackRock is also managing our U.S. As well as non-U.S., as well as fixed income index allocation. So this makes sense as opposed to kind of parsing it out, if you will, because you can attain attractive relationship pricing. And again, on the U.S. piece, I think the effective basis points for the Dow Jones, I believe, was about 1.9, and then the S&P about 1.5, and then going to the Russell 1000 would drop it to 1.25 non-lending. So this is a very attractive rate. We can shop it around further, but we feel pretty confident, in this index area, it's pretty commoditized. The only sort of differential there is if you're lending securities, not lending securities, that can cause some spread or difference in terms of the basis point pricing. Also, just while I'm on it, moving strictly from the broader non-US all-country world ex-US IMI index, which includes EM and international small cap, to just the world, which excludes EM and small cap, that is also creating savings for us on just the passive piece.
Okay, thank you very much.
Sure thing.
Good morning, everyone. So Karina did a really nice job of overviewing the changes for structure, so I think I can make this pretty short and sweet and then open it up for questions. So maybe if I just start on page 4, just to give an overview of what portfolio structure means. So when we think about the pyramid and we talk about how 90% of your returns are driven by asset class, this is kind of that next 5 to 7% or so. It's how do you implement the asset class policy that was just approved? And how do you actually go about hiring managers, thinking about active versus passive management, making sure you have the full coverage of each asset class, such as within US and non-US markets, and ultimately selecting managers and the number of managers you have as well. So all of these are components of what we call portfolio structure. So we do review this annually to make sure that it still is appropriate and see if there's any opportunities to make small enhancements to the portfolio. We wouldn't expect it to change drastically on a year-over-year basis, but generally we might have a couple of recommendations each year for the portfolio. So if we turn a couple slides over, I think slide 7, I'll just walk through at a high level what the recommendations are today. Again, these are for the US equity, non-US equity, and US fixed income portfolios. So within US equity, as Karina mentioned, we're looking to consolidate the 2 US equity indexes, which are the Dow Jones Total Stock Market and S&P 500, into a single broad market index that invests in large and mid-cap stocks. This would be the Russell 1000 for the passive portion of the portfolio, while retaining that dedicated allocation to William Blair's mid-cap. So in concurrence with this change, we're also recommending that the US equity policy benchmark be changed to the Russell 3000 from the Dow Jones US Total Stock Market. There's a few different reasons for this. Both indices do represent the broad US stock market. The Dow Jones does cover just about 100% of the investable universe. The Russell 3000 is about 96%. So it does lop off that bottom about 4% of microcap stocks. However, when you look at the historical returns, they're very similar, tracking errors, everything. Both indexes are very similar. So we're comfortable using both of these indices for a US equity portfolio benchmark. And moving to the Russell 3000 will make it so that the index family is all aligned. So the tracking error will be more minimal, especially with 94% of the portfolio being passively managed. We don't want to introduce noise, any unintended noise there. So just really just making sure that the fund family is consistent between the implementation and the benchmark that you're using. The second recommendation, again, this is a little bit of a to be determined with the non-US equity structure, but ultimately what we're looking at is potentially adding some more active management in this space. The portfolio today is roughly 60% passively managed. So it's a very low cost structure, but we do believe that there is some opportunity to add alpha within non-US markets as they tend to be less efficient than US markets. And as Karina mentioned, your active risk budget, you have plenty of room there to potentially increase active management a bit, in addition to the fact that the global equity portfolio, which is 100% actively managed, is being reduced by 2 percentage points. So what we're looking to do here is take the passive index exposure, which is the ACWI ex-US IMI, and this essentially it covers everything in the world except for US. So it covers developed, emerging markets, and then large all the way down to small cap. That is your policy benchmark, and that's also what the passive implementation is today. So what we're looking to do is transition that passive exposure to a world ex-US index. This would lop off the emerging markets and the small cap piece, and we would put those into the active exposure. So currently you do already have active exposure to small cap and to emerging markets, but we would just look to make that 100% active. Now what's important to keep in mind is the total structure will remain neutral. So what I mean by that is we're looking at the policy benchmark, and it's roughly 73% developed markets, 27% emerging markets today. And then we're also looking at the market cap spectrum, the percentage to large, mid, and small. So the overall structure will still have market weights to emerging markets, to small cap. We're just simply going to shift some more passive into some more active. And so by doing that, we're actually going to look at the managers. We might conduct a few searches to go along with that, and then structure that portfolio depending on how we want to divvy up managers, and also looking at allocations between dedicated emerging markets, dedicated small cap, and maybe broader international mandates as well. So more to come on this structure, but we're really just looking for the committee's approval or the board's approval to move in that direction of increasing active, particularly within emerging markets and small cap. And then the last recommendation within the US fixed income portfolio is to eliminate passive management in this portfolio. So this is something that over time, gradually, we have been adding more to active management within fixed income. The fixed income benchmark, which is now going to be changed to the Bloomberg Aggregate Bond Index, is not the greatest proxy for the overall US bond market. It's heavily weighted towards treasuries, and it also doesn't represent the full market. So what we have found is that active management has actually done quite well within the core fixed income space. And in addition, active management in fixed income comes at a fairly competitive fee. I think the current fee today for your active managers is slightly under 20 basis points. So there's less of a fee differential that active managers have to overcome within US fixed income to outperform that benchmark consistently. So we're recommending removing that passive allocation, which is currently at about 30% of the portfolio today, and then looking to hire a third core or core plus bond manager to complement the existing managers, which are TCW MetWest and PIMCO. With that, I will open it up to any questions. All right, thank you.
So as I indicated earlier, these items were discussed yesterday afternoon by the investment committee, and on this second action item, we had 3 individual votes that all were voted 5-0 in favor of recommending to the entire board. And so I see we have a motion. So do you need to read these motions now or later, Rosie?
That is up to you, Mr. Chair. I'm happy to do
I think
either.
people know, and maybe we can vote while everyone's waiting, and then we can read it for the record.
So please forgive me, everyone, because we do have a couple acronyms here that I will just read as such. The motion to approve staff and consultants' recommendation to firstly transition SDCERS to passively managed BlackRock U.S. equity funds to a Russell 1000 index fund and change the U.S. equity benchmark to the Russell 3000 index. Secondly, transition the passive exposure in the non-U.S. equity asset class from MSCI ACWI EX US IMI to the MSCI World EX US Index increase the non-U.S. equity active management in the emerging markets and international small/SMID cap allocations, and lastly, transition the U.S. fixed income passive mandate to a core plus active management mandate. And that would be the motion that you will be all voting on right now.
Thank you, Rosie. I see the votes are in.
So with all votes in, we have, this motion passes 10-1 with 1 voting no.
Thank you. I believe, Lisa Marie, you have a question you wanted to ask now?
Sure, just in terms of the investment division report, Karine, I saw that you guys had several due diligence meetings. Can you give us a summary of how those meetings went?
Certainly. Yes, we did actually have several meetings. Do want to note that it had been a while since we had done on-site due diligence with several managers, and Anders Norman took a trip and visited with those managers, and that's in keeping compliance with our policies to do on-site visits. It had been some time also since the COVID period where we had not been traveling to meet those managers, but we did gain a lot of insight from meeting with the managers and able to also speak with their portfolio management teams, get a business update, and understand any developments with the current portfolio holdings and get their market outlook. So I don't know if you want any further information or specifics.
Interesting insights.
Interesting insights. Well, you know, I think honestly that there's just a lot of concern and caution on the part of our managers as a whole. I think there's it's not really clear exactly if we're going to go into recession, if it's going to be a deep and long recession, but I do think that most think we are and are getting more defensive and more up in quality in the portfolio to protect against that scenario. So I think that on the whole, I would say those would be sort of the common themes from those various meetings. Would you like to add, Anders?
Yeah, so maybe also on the non-investment side from those meetings, we did talk to each manager quite a bit on their compliance and IT efforts. One big thing that we covered with them in depth was their cybersecurity efforts, since that's become a very big issue for managers, and we want to make sure that they're up to date on everything. So that was something that we really covered with each one of them. So I just wanted to mention that too.
Thank you, Cliff. So that concludes our investment committee section. Let's move on to section number 9, questions and comments from the president, trustees, and staff. So do we have any questions or comments or education session reports from the board members themselves? If not, again, welcome to Chris Brewster, and thank you for your VP and committee chair submissions. Do we have any questions or comments from staff? Greg, I think this is your turn.
Before I give my lengthy comments, I would like to ask Johnny to say something. Yes, please.
Great. Just good news, the update on my legal staff report. We have a litigation brought against SDCERS by CTAN, the California Taxpayers Association Network. It was brought in 2021 alleging that Proposition B wouldn't allow a existing member of the system to be elected to office and continue to be part of SDCERS. With Proposition B being invalidated, we hoped that lawsuit would have gone away, but it didn't. So we filed a motion to help that process along, and the court granted that motion yesterday. So I just wanted to share that with you, and thank you for trusting staff with that case. Thank you.
Excellent. I would like to start by welcoming and thanking Chris Brewster, to my right, for stepping up and being elected as our SDCERS retiree representative. Chris attended his SDCERS orientation, and I will tell you, it was an invigorating and invigorating day with lots of interesting conversations. It was really actually truly enjoyed to have Chris's engagement. Definitely a fun, engaging day. I'd also like to echo the President's appreciation to our board leadership. I look forward to working with you, Lisa Marie, and our board chairs, Bobby, Cliff, and Tom, in the coming year. So thank you, and I really appreciate you for stepping up into your leadership roles. As many of us know, the SDCERS board membership terms are staggered 4-year terms, and this past March 31st, we had 2 appointed members, President Kaufman and Chair Shearson, whose terms ended. Fortunately, they agreed to continue serving while their reappointments to a second term are being considered, and I'm very pleased to report the mayor's endorsement for appointment is being scheduled to be heard by the City Council following the city's current budget hearing. So that is very good news. And I would like to say I really appreciate President Kaufman and Chair Shearson's patience as the wheels of bureaucracy slowly turn. So thank you for your patience. I'd also like to recognize SDCERS board member Louis Nguyen. Welcome, Louis. For his appointments to the California Healthcare Foundation Board of Directors. The foundation board chair said, "We are honored to have Louis join the CHCF board, bringing his extraordinary experience professionally and personally, working to make systems more equitable and more connected to the community he serves." Congratulations on your appointment, Louis. I would like to recognize and thank Paul Kaufman, President Kaufman, for donating his photographic art of our San Diego community for display in SDCERS workplaces. We are in the process of getting his images printed and framed, and this incredibly generous donation will brighten up our offices for many, many years to come. So thank you for your donation, Paul.
You're welcome.
Greatly appreciate that. And for those who love San Diego like I do, Paul recently published a wonderful book called San Diego, the City of Neighborhoods. It is a visual essay focused on architecture, public art, and landmarks from various San Diego neighborhoods, which is a really important part of why San Diego is such a special place to be. So if anybody's interested in the book, you're welcome to peruse my copy.
Or just walk around the offices.
Or, yeah.
Thank you very much for making my Form 700 considerably more complicated.
There is no Form 700 reporting, so you're all right. I would like to also recognize and thank the board for an engaging board retreat that we held this past April, where we discussed board governance and the investment program, and a note of appreciation to our staff and consultants, including Aon, our investment advisors, for their impressive preparation, which sparked a lot of valuable discussion and insights during the day. So thank you, board, for your engagement. Switching topics a little bit, the City of San Diego requested SDCERS to present the city's 2022 actuarial evaluation to the City Council and to provide an actuarial education session. We were fortunate to have SDCERS actuary Gene Kalwarski and Ann Harper with Chiron were available to make those City Council presentations. The City Council was quite engaged, and the session resulted in a news article. Regrettably, the news article included quite a bit of creative journalism in surmising the costs of various planned funding options, none of which were presented during the meeting, nor were provided by SDCERS or Chiron before or after the meeting. The news reporter also took creative liberty to say what the SDCERS actuary is likely to recommend to the board as prime options when Chiron begins our experience study discussions at the July SDCERS board meeting. A note of appreciation to Marcel for stepping up and fielding City Council questions that were really beyond Chiron's scope of response. So thank you to Marcel, appreciate that. The city also requested SDCERS to provide an informational presentation to the on the SDCERS budget as part of the City Council hearing process. The presentation went well. The City Council expressed gratitude to this board for their taking care of for its professionalism and taking care of the responsibilities. We were asked to keep our comments to a maximum of 5 minutes before the city council, and I am very proud of Ted LaSalvia for keeping focused, being brief, and expertly concise. We almost made our 5-minute mark, but we were pretty darn close. While we may have exceeded our time limit, it was all right. The council was very, very happy. There was no public comment, and we enjoyed responding to 2 questions, but they were non-budget related. And I'd also like to express my gratitude to Lisa Byrne from the city's Independent Budget Analyst Office for her thoughtful and accurate overview of SDCERS budget. She's a really pleasure to work with. I'd also like to recognize and thank the City of San Diego and their unions for negotiating to improve city's compensation strategy to be competitive in the labor market. Their recent multi-year labor agreement through July of 2025, which also applies to SDCERS represented employees, will help remedy the wage gap created by the city when the city froze compensation for a 5-year period following the Prop B plan closure. I would like to recognize and thank our Chief Investment Officer, Karina Coleman, for being a featured speaker at the CalPERS Advanced Principle of Pension Governance for Trustees. Nice job, Karina. Thank you for getting involved. In closing, I would like to recognize our information technology team for helping all of SDCERS staff improve their cyber security skills. We receive regular training on how to protect our computer systems and information. One such training is email phishing campaigns that are designed to trick you into opening a fake bad email that you should really delete. Historically, SDCERS staff love clicking on everything. Many staff regularly failed the email phishing campaigns and were required to have remedial training. Our latest phishing email was cunningly disguised as a cyber training email, and I am proud to report all staff either trashed the email or reported the email using the fishy email button. Our fight against cybersecurity threats is never ending, and I'm really pleased that we continue to fight. And that concludes my comments. Thank you.
Thank you. We're going to move on to Section 10, which is closed session. Johnny, do we have any closed session items?
We do not have any closed session.
Okay, thank you. Since we're not moving in, are we moving into closed session? I don't think so.
No.
Yeah,
but-
okay, excellent.
But we have to ask about closed session report outs.
Oh, excuse me. So do we have any closed session report outs, Johnny?
We do not have any closed session
Okay.
reports.
Thank you. Can we move on now? Okay. Excellent. So I think at this point, we conclude the meeting. Any other further comments from the board? Okay, I'd like to announce that this meeting is adjourned. Our next meeting is held on July 14th here in the SDC boardroom. Thank you very much for your attendance.